Okay, good afternoon, everybody. I'd like to get underway, and please take your seats as soon as you get your lunch. So, before we get into the topics that are focused much more on macroeconomics today, I thought it would be interesting to just look at the daily news. These are 3 stories that I pulled down off of a site called CoinDesk, which there are many sources of news about blockchains, but this is the one that I think does the best job, and every day I read it right after I read the New York Times, and you get both a lot of data about the crypto markets, but also a lot of news about new initiatives and new programs around the world. So just in the last 24 hours, the U.S. Food and Drug Administration put out a request for proposals for using blockchains to track healthcare data. And I mentioned a number of times that public sector applications may be ultimately the most promising uses of this technology, and having accurate medical records is obviously something that many societies have identified as an important goal and have struggled with finding good ways to implement this. On the bottom is a story from Sweden where they are introducing a beta test of a land property registry for the real estate markets. This is another idea that has been widely discussed. More often it comes up in emerging markets that have bad property records or an awful lot of corruption. Places like Venezuela, for instance, would be the ideal uses of this. Sweden is maybe the country that least needs this of any country in the world, but also maybe the one that could introduce it with the greatest ease. And it would potentially improve it would save money in the real estate market and attach more certainty to the ownership of assets and so forth. So I think this is a very interesting thing that in 10 years' time you may see this in many countries, moving the real estate registries onto blockchains. And then finally, in the top right, this is a funky story about Julian Assange, the WikiLeaks guy who is holed up in the embassy of Ecuador in London. There are rumors that he's dead, that maybe in retaliation for stuff in the campaign, the CIA, who knows. But to prove he was alive, he went on the internet last night and read off the hash code from the most recent block in the Bitcoin blockchain that had just been mined. And he says, for proof of life, the most interesting way is to have the most recent block in the Bitcoin blockchain to prove that it's like hostages with headlines in that day's newspaper and so forth. So this was a very interesting idea, and he has an obvious talent for showmanship and so forth. But what the blockchain is ultimately about is authenticating things, that something existed at a certain point in time, and we can all rest a little easier that, in fact, WikiLeaks, the founder is still very much at work. Now, our topic for today is central bank digital currency, which essentially is taking this wildcat idea that was really created to undermine or compete with the central banks of the world and think about them bringing it in-house and using it. And on the right is a recent story from the Financial Times that simply highlights the fact that many governments around the world are looking at this very actively. The one that you would really want to learn more about if you're interested in this is the Bank of England. About a year and a half ago, they put together a team with a lot of academics, internal part of their research staff. It's called The Future of Money. And they have put out a number of white papers that essentially amount to a design of what this would look like in the UK. And it gets into an enormous amount of detail about what this would mean for the commercial banking system, for customer payments, and just all kinds of externalities, both good and bad. Extremely thoughtful treatment of the issue. And it's surprising to come out of a country like the UK because they have a very old, conservative, traditional central bank and a financial system that on the whole works pretty well, that they aren't obviously the best candidate for this. But they are definitely the destination, that if you're interested in sovereign digital currency, your first stop should be what's going on with the Future of Money people at the Bank of England. And they've gotten in some hot water with the British Parliament. They've actually been called into Parliament to disavow that this is a secret plan, like that they're going to do this next year or something like that. There's a lot of concern that this is really a political decision that should be made not by the central bank, but by Parliament. But they're pretty far down the road, at least with designing this thing. And I would point to the central banks in Canada, Singapore, and they're also including Russia and China. I'm not quite sure that's accurate, but many, many major countries are now at least looking at this idea. There are two countries that have actually done it already, and that's the news story on the left. Tunisia actually has a blockchain national currency that is legal tender, and just about a month ago, Senegal became the second. So you have two African countries that essentially have an electronic currency blockchained and circulating side by side with the more traditional paper money, the bills and coins. And so this is an idea that is really already here, but my suspicion is that you're going to see this be adopted and spread into some of the more major economies. I think that either Sweden or Singapore is the best bet for who will be the first, major large economy, but if the value of this is proven, many other countries will fall pretty clearly into line. Now, I want to talk about three ideas today that I think are quite closely related to one another. And the first is just to look at the independent cryptocurrencies, Bitcoin especially, but some of the others, and to make some evaluation about whether these are serious threats to the sovereign currencies that are out there. In other words, if you are Janet Yellen running the Federal Reserve, are you worried about Bitcoin as a competitor to the US dollar? Is this a serious threat that private money could drive the government money out of circulation? If it did, this would put us back in the 19th century to what is called the era of free banking, when essentially banks issued their own private money and it was either used or not used by the public, really based on the reputation of the bank, and that currencies competed against each other and governments played a much more limited role in issuing money with the backing of the government. Now, this is something that we all thought had more or less disappeared by the dawn of the 20th century, but one of the interesting things about this is that it puts you back really into the world of classical economics from 150, 200 years ago. And the money back in the 19th century was really backed by gold. And is Bitcoin and is a blockchain type currency really a type of digital gold that would operate much the same way as the gold standard did 100, 150 years ago? So we'll talk about this a little bit. And the closely related question is, if you look under the hood of these currencies, the distinguishing feature of them is that there's a rate of money growth that is pre-programmed. And we'll look at this closely for Bitcoin, but the whole idea with a private currency is that the sponsor of the currency might show more restraint than a government would about printing too much of it. And in particular, if you could commit to a rule that everybody knew the rate of future money creation and money growth, it might make money neutral in the economy in a way that has often been advocated by people like Milton Friedman, and in fact a lot of people associated with the monetarist tradition, many of them having taught at this university. So if a digital currency can pre-program a rate of money creation that is in some sense better for economic growth and for trade and transactions and so forth, could a central bank commit to the same kind of thing? This is actually a very old debate about monetary policy. There's a huge amount of macro research that goes into the question of what is the optimal rate of money creation, and if we knew what it was, could the central bank commit unconditionally to following that rate? And this is sometimes called in shorthand the rules versus discretion debate. Should there be a rule of monetary creation, or should the central bank have discretion to fine-tune it, adjust it in response to emergencies, etc.? This debate has, again, been revived, and a lot of life has been breathed into it due to the arrival of these cryptocurrencies, which seem to be able to offer a rule that is extremely transparent and can be exactly programmed. And then finally, the the limiting question of all this is, why doesn't the central bank just take this whole thing and bring this technology in-house? So rather than printing greenbacks and circulating bills and notes, why doesn't the Federal Reserve just put everything on a national blockchain and make all of the money electronic? This is something that I think is probably going to happen. And we'll get into this in more detail, but I think everybody recognizes very easily that most of the money already is electronic. You use cash really just for micropayments, but probably upwards of 90% of your actual spending is with credit cards or bank transfers or some other virtual form of transacting where you don't actually physically pass. And so the idea that all of the money should be electronic is not so much of a change from how things already are. But if it's tracked on a blockchain, it begins to raise questions like, do we need the retail banks to take deposits and engage in fractional reserve lending? Or could everybody just have an account at the Federal Reserve? This is an idea called the narrowing of the banking system. And again, it refers back to older ideas, many of them from the University of Chicago in the 1930s, about how you might make the whole system less risky and more reliable. So these are very interesting questions which are of first-order importance for the economy. And I began to take these seriously. I studied Bitcoin beginning in the fall of 2013, and my colleagues for a while made fun of me and said, how's Bitcoin doing today? And, like, what about your real research? And, what are you wasting your time on? And then I got an invitation that following spring to go to Basel and meet with the central bank governors in a meeting that was never publicly announced. And the agenda for that meeting was exactly this. This turns out behind the scenes exactly what Janet Yellen and Mario Draghi and all the governors of the central banks of the world are actually quite concerned about. Like, is this thing viable enough to be a real threat to the money that they're issuing? And, should they think in terms of this algorithmic monetary policy and so forth? So it turns out that the central bankers are far out ahead of the academics, and that this has been an issue of great interest to them for quite some time. And I think it's now been opened up to a lot of public debate. Really, in the end, these are political questions that are beginning to be interesting to people throughout the world in many of the advanced as well as the developing economies. So you're likely to hear much more about these things over the next 5 to 10 years. Now, the irony behind all this, of course, is that the design of the whole digital currency, and Bitcoin in particular, was meant to undermine the central banks and to compete with them head to head. And the evidence for this comes directly from Satoshi Nakamoto when he created the first block in the Bitcoin blockchain. This was on January 3rd, 2009. This is called the Genesis block, like the first verses in the Bible. And he coded into the memo field the headline from that morning's Times of London. This headline right here, the Chancellor on brink of second bailout for banks. So everybody who follows Bitcoin closely knows that the Genesis block has this message built into it, which is meant to poke fun at the weakness of, in this case, the UK banking system. So this front page of the Times of London from that day is now a huge collector's item. If you want to impress like a Bitcoin aficionado, like give them the birthday present that they would dream of, find a copy of the Times of London from 8 years ago, January 3rd, and everyone knows this headline, Chancellor on brink of second bailout for banks. But Nakamoto also went online and posted manifestos against central banks, and the very famous quote is the one I've pulled out here in the lower left, that the root problem with conventional currency is all the trust that's required to make it work, and in particular, the central bank must be trusted not to debase the currency. But the history of fiat currencies is full of breaches of that trust. So Nakamoto very openly was trying to create an alternative to central banks. And the people who have gravitated toward this often have this libertarian anti-government streak. So you see conferences like this one. This is a panel discussion led by Nathaniel Popper of the New York Times on the right, and he points out that it's true fact that 10% of all Bitcoins are at this point in the hands of criminals who have hacked and stolen them. And on the left, you have a guy named Andreas Antonopoulos, who's a Bitcoin evangelist. He says this is a vast improvement over the rest of the economy, where 80% is in the hands of the criminals, the banks. And these are people who hate the whole system. You've got Susan Athey, a very famous Stanford professor, in the middle, kind of wondering what she's doing there with Andreas Antonopoulos. But these are people who have no patience with the current banking system, who are really trying to start something new from the bottom up. Now, the law in this area is a little bit murky. So every country handles this issue a little bit differently. But in the U.S., we have something called the legal tender laws, which go back to the period just after the Civil War, when the U.S. government was deeply in debt and it began to print money and force people to accept it to pay off what at that point was a lot of debt left over from the war. So there were two cases where the U.S. Supreme Court ultimately ruled that people had to accept U.S. dollars issued by the central government. This was prior to us having the Federal Reserve or any kind of a central bank. But since that time, and it's now, 145 years, if anybody owes anybody else a debt in the U.S. and you present for payment government-issued money, they must accept it. So it's legal tender for all debts, public and private. You've read this on the money. Now, what the law does not say, though, is that you don't have to, you can accept something else. The law doesn't rule out other forms of money. So if I owed John $1,000, I could give him 1,000 US dollars, but I could also give him Ithaca hours, which is a currency issued in Ithaca, New York, based on the labor theory of value by a community of people who don't like the regular money. And if he wishes, he doesn't have to accept it, but he could. And in fact, there is all kinds of private money that circulates, often in small communities in the U.S., and this has been true for a long, long time. Now, sometimes the government loses patience. And a well-known recent case involves something called the Liberty Dollar. This is a coin that looks like a U.S. dollar, but look close and it's not really the same thing. So it says Liberty Dollar, trust in God, not in God we trust. It doesn't mention the United States anywhere. And it was issued by this man named Bernard von Nothaus, who runs an organization called the National Organization for the Repeal of the Federal Reserve. Now, this sounds like a guy who today would be almost in the mainstream. But back in 2011, they arrested him and put him in jail for counterfeiting. And not before he got his picture taken with Ron Paul, the congressman from Texas and sometimes presidential candidate. Now, was this guy in violation of the legal tender laws? And if so, why exactly? And I'm not going to try to answer that question. But this seems to be an area where the government in the U.S. has at least some patience with private money. Nobody's suggested, for instance, that Bitcoin is illegal. But if you go too far, they will put you in jail and say that you are bumping up against the government's right to issue money, and so forth. The law is even more confused in other countries. But the real point I want to make is that private money does exist. It has circulated, really since the beginning of the country. But the government is, it seems to be unwilling to let it get enough of a critical mass that it becomes a serious threat to the U.S. dollar. Now, how big are the digital currencies that are out there circulating now? There are more than 700 of them, and we'll look at some of these colorful names in a minute. But by far the biggest is, of course, Bitcoin. And I took these numbers just last night off of the web. The market cap of Bitcoin is a little under $15 billion. Now, how much real money is there, U.S. dollars circulating? It runs into the trillions. It's a little bit hard to measure because a lot of it is electronic and based on bank balances, and to actually put a number on it is challenging for the Federal Reserve. But Bitcoin is a tiny, tiny drop in the bucket compared to the volume of U.S. dollars, either the physical money or the much bigger amount of virtual dollars that exist in people's deposits and so forth. And if you go down the list of other virtual currencies, they become even smaller much more quickly. So even the second biggest, which is Ethereum, this is the one we talked about yesterday that ran into all the trouble with the hard fork. Ethereum is not even 10% of the size of Bitcoin. The sixth largest is the rival Ethereum, the Ethereum Classic, which is 126 million. I pulled these two out because they're kind of interesting. Steam is a video game currency. It's issued on a gaming platform where people play these massive open online games. And it's a unit that really was designed to be used internally to the game, but it's now traded outside the game and actually has a market value. It looks a lot like money, and it's, at this point, the 10th largest digital currency. Zcash was launched about 2 months ago, and in the earliest weeks, it got a huge amount of publicity because it had design features that were better than Bitcoin in the sense that there was total privacy, that you could exchange this on a blockchain, but nobody could actually see who you were or who held which units of Zcash. This seemed to be a very promising way for people to launder money and buy drugs in ways that I've suggested would not be a good idea with Bitcoin. But this thing, all the air has gone out of it. It at first was trading for $2,000 for one Zcash, but it's all but collapsed. I think if you come back next week, it might be 170th on the list. And then all of the others combined are worth about 1.3 billion. So many of these are kind of fun to look at, like, you know, Mars coin, there's a Ron Paul coin, Rainbow coin, Pot coin, Piggy coin, you know, whatever. If I once was interviewed by a linguistics columnist who was writing about all the funny names, and some of them are like 4-letter words that we would never say in public and so forth. But there's a money circulating. All of these are on blockchains, and all of them are wannabe competitors to Bitcoin, but they're tiny. And even Bitcoin is so small that it's hard to take seriously as a rival to any sovereign currency at this point. And as we've talked about earlier, some of the constraints with the block size and the throughput, I think there's not going to be anytime soon any serious threat that the central bankers have to worry about. And you're going to need some real advances in technology before any of this private money can be taken seriously as a competitor. But at least the idea is there. And it's drawn a big audience among the libertarians. When I teach my course in New York, you get a lot of these people signing up from, you know, some of them are from the law school, the philosophy department, but they hate government. And they think that, you know, this is part of an agenda that will make the state recede from its oppression of us in our daily lives and so forth. And they have some sharp critiques of the banking system. So this is very much along the lines of Satoshi, that they think that banks can't be trusted. And one of the great things about Bitcoin is that it gets rid of the banks. You can just keep it in your own digital wallet and you don't have to hold it in a bank. The second point is really the algorithmic creation of money, that governments always inflate the currency to the point that it's worthless. It's just a question of when, not if. And with Bitcoin, you've got a set of equations, and we know that this will never happen. Libertarians tend to object in principle to monetary policy. They view things like quantitative easing as distortions in the forces of supply and demand, and disguised subsidies from people who know what they're doing to people who should but don't and are too lazy to, you know, arrange their affairs in the right way and lean on governments for economic support. And, you know, there's a whole agenda here that makes digital currency very appealing, and at the same time, the left views it pretty much 180 degrees differently. So you guys all know who Paul Krugman is, the liberal columnist for the New York Times. He wrote a blog posting a number of years ago, headlined simply, that Bitcoin is evil. And to Krugman, it's evil precisely for the reasons that the libertarians like it, because Bitcoin seems to rule out different kinds of monetary manipulation and stabilization policy that, at least in the opinion of Krugman, has proved to be very valuable in things like the financial crisis to stabilize a free-falling economy and so forth. So this is a political debate, and we're not going to parse it out. But let's look at the rate of money creation behind Bitcoin and think whether this would actually make sense for a real government to implement. And if not this rule, some other rule that looks like it. So what happens with Bitcoin is that the currency does get inflated every 10 minutes when some miner creates the next block and claims the reward of the Bitcoins that are put out there as the incentive. So you guys have probably studied in other courses what we call seigniorage, which is the government printing money and releasing it into the economy. So in the US, the central bank puts money into the economy through what we call open market operations. That there's basically a trading desk where they either sell or buy bonds from the public and thereby release cash or contract the money supply. Bitcoin is totally different. There's nothing like that. Instead, the seigniorage on Bitcoin is by way of the miners. And every 10 minutes, there's a reward, which is 12.5 new Bitcoins, or roughly $10,000 worth of money measured in dollars. Now, this reward was originally 50 Bitcoins every 10 minutes, and it was stipulated by the code that every 4 years it will be cut in half. So it was cut in 2009 it was begun at 50, in 2013 it was cut to 25, and then quite recently, just a few months ago, it was cut to 12.5. And then again, it's not exactly 4 years, but I think in 2021 it's due to be cut again to 6.125. And what this means is, here's the reward here, and this is the cumulative size of the money supply, which is going to follow a concave function because the reward is cut in half every 4 years. And then it will asymptote eventually to zero growth, and by the year 2140, you actually have to go all the way out much further, but there will be no more reward for the miners, and the number of Bitcoins will be fixed forever at an upper limit of 21 million. Yeah? Yeah, this is a very good question. And in fact, Janet Yellen asked me exactly the same question when I went to Basel. And the answer, I skipped over this before, but when you put a transaction into the blockchain, you can offer a little tip to the miner. So you say, I want to send 8 Bitcoins to my friend Alice and 0.01 Bitcoins to the miner who puts it into the block. So people actually include little user fees that are ways of giving the miner the incentive to pick your transaction and build it into the block. So it's a quiet auction system that whoever puts the biggest fee to the miner is going to be the one picked first for the next block. And it's a way of actually bidding for liquidity, which is quite interesting, that rather than processing the transactions on a FIFO basis or LIFO, whoever pays to cut the line gets into the next block. So what Nakamoto had in mind, and he writes about this in his original paper, is that you need this reward system to bring miners in and create a critical mass of people, but that over time he wants it to transition to a system of user fees. So the answer to your question is that people will pay the miners and they'll bid for liquidity essentially, and if you can wait and have your transaction processed overnight, you'll put 0, but if you want it processed quickly, you'll pay more. So that's the idea here, that the blockchain will continue to be financed really 100% by user fees. Now, where did they get this rate of money creation? Like, if I asked you guys to sit down and say, write down the optimal rate of monetary growth, what should it be? It's unlikely you would have come up with this, that we're going to cut it in half every 4 years until it's fixed forever at X, where X is 21 million. And if you go online and try to learn about, why did they set it up this way, you will find quotations like this, that they chose this very deliberately to approximate things like the historical rate of gold mining. So if you think about when people discover gold, they take the quick and easy deposits, and then they have to work harder and harder, and then they use, in the oil business, things like fracking to get every last drop out. But the growth rate, the production of gold, allegedly, is concave over time. And so the rate of Bitcoin creation, according to the evangelists online, was designed to mimic the history of gold mining. Now, I thought maybe we should look this up, and let's come back to this in just a moment because it turns out to be completely false. But this is at least the legend behind it. Now, the logic is interesting and really very straightforward. This is the kind of thing that Milton Friedman probably would have been very comfortable with. So the whole idea here is that they're worried about inflation. And if you think inflation is caused strictly by the money supply, if we fix the money supply, we'll never have any inflation. But the real point of the research of Milton Friedman and others is not that there should be a fixed money supply, but that money should be neutral. And what that really means is that money should grow at the rate that the economy grows. And what you're looking for is not a stable money supply, but a stable price system. And if the economy grows exactly 3% a year and money grows 3% a year, then prices shouldn't change. And that's a somewhat different idea than what these folks have in mind. What you would get with a rule like this, in my opinion, is, of course, deflation. That eventually, if you just fix the amount of money and the economy grows 2%, you'd have to cut everybody's wages by 2%. And if I cut you only 1%, I'd say you got a raise. And you'd have to think, yeah, I'm better off than, because everyone else dropped 2%. That would require people to change a lot of their behavioral frames of reference and so forth. And maybe over the course of hundreds of years, people could adapt to that and think a little bit differently about what it means to be better off. But I think ultimately, if you're hoping that the economy will grow, having a fixed money supply or really a very low rate of growth even is going to force prices to drop basically at the rate of economic growth every year just to stay even. Nevertheless, if we can look at this rule and know exactly what it is, we can plan around it. So this debate about rules versus discretion says that above all, people want certainty. And whether it's going to be fixed or whether I know for sure it will grow 10% a year, as long as I know what it will be, I can then write my debt contracts and build in price. I can do whatever I need to do without any risk of the government devaluing my money beyond my expectations. And so there are things like the Taylor rule that you may have heard about in macroeconomics that stipulate what an optimal monetary policy might be if the central bank could tie its hands and commit to it. And here, you're really, by announcing 100 years in advance what the money creation is going to look like, you're giving people all the information they need to write debt contracts and arrange their economic affairs the way you would want. And it would be the case that governments would be not only deterred, but really impossible for them to use monetary policy to stabilize the economy. Now, here's the rate of historical gold production. It turns out you can get good data about this back to the times of the Egyptians, like in 2000 BC. And the rate of gold production has been convex and not concave in history. In fact, in the last couple hundred years, the rate of gold production has accelerated in a way that is completely at odds with what they have in mind here for Bitcoin. So, maybe there is a good reason that this should be convex, but by appealing to the history of gold mining, that's not the explanation. That whoever wrote this basically had no idea what they were talking about, in terms of the historical data. It's fun to point this out to the libertarians, and then they turn a little bit red, come up with some other angry argument. But what you're talking about here ultimately, though, is going back on the gold standard. The logic of this is very much what the logic of monetary policy was really throughout the world, at least up until the time of the Great Depression. So we could call this the gold standard, or more broadly, a commodity standard, where the money issued by the government is constrained by the supply of some real good, which typically has been gold through history. And for the government to expand the money supply, they either have to dig more gold out of the ground or more likely buy it from some other nation or take it as booty in wartime or something like that. And the way you basically expand the money supply is by expanding the stock of gold. And the virtue of this, again, is limiting the ability of the government to debase the currency. That if you have a gold standard, and it used to be the case that in the US, a dollar bill could be traded in $32 for 1 ounce of gold and so forth. This was thought to discipline the government and protect the wealth and functioning of markets and so forth. Now, the history of our country, you may or may not have studied this closely, but for many years this was really the central issue in our politics. And the height of this was the populist movement, which culminated in the election 120 years ago in 1896, when this young lawyer, William Jennings Bryan, ran for the government, or for the Democrats against McKinley for the Republicans, and he made the very famous Cross of Gold speech, saying that the gold standard was tyranny, and that the government should print more money to support farmers and working people and so forth. And he was not the first or the last person to go down this road. There was something called the free silver movement in the 19th century, also called bimetallism, where you're essentially arguing to expand the monetary base by making not just gold but silver the basis of currency. We had this fight politically for the better part of 100 years in this country. And it was not until the Federal Reserve is created in 1913, and then even after that, ultimately it took until 1971 when Nixon finally took the U.S. permanently off the gold standard, until this was resolved in favor of paper money and discretion for the central bank. But this is a big debate, and what a lot of the Bitcoin sponsors are trying to do is essentially reintroduce this argument. I've made references in class to the cross of Bitcoin, thinking the students would all know this history and connect it to William Jennings Bryan. It's not so easily done, but this is exactly the logic that you're talking about. And you may or may not know that the Wizard of Oz, this beloved children's story, the wizard is in fact the gold standard, and then Yellow Brick Road and the Emerald City. This is all based on the populist movement, and it's an allegory for the tyranny of the Republican Party back in the day. So the gold standard ultimately collapsed for the very reasons that I suggest that Bitcoin's concave growth rate would run into trouble, that it just didn't grow fast enough. They didn't discover gold quickly enough to accommodate the growth of the world economy. So the gold standard, you may be surprised, it's invented by Isaac Newton, of all people, and introduced by the Bank of England in the 1720s, and it lasted about 250 years. But in times of war and times of economic crisis, it was periodically suspended because it became a serious obstacle to economic stabilization, so in the world wars and depressions and so forth. And ultimately, despite a last stand to kind of save the gold standard by John Maynard Keynes at the Bretton Woods Conference, by the 1970s, everyone agreed it just wouldn't work. So I think this idea of algorithmic monetary policy, whether it's through Bitcoin or through the central bank, in the end is not going to happen because there are too many good reasons we already have not to use it. And it's worth pointing out that the governance of the digital currencies themselves probably wouldn't support it. So the belief is that the supply of Bitcoins is fixed at 21 million, that that's all that there can ever be. And in fact, I told you this 5 minutes ago. And this is true if you look at the Bitcoin code and so forth, but the reality is that that code can be changed. The blockchain can be forked if 51% of the people agree to go down a fork. So somebody tonight could say, let's change it from 21 million to 30 million. And if you can get 30% or 50% of the people to follow you in the direction of a different limit, the 21 million would be gone. What this reduces to is essentially mob politics, that anyone who can get 51% to go down that fork, and we've seen a lot of politicians around the world get people to follow them for crazy policies. We don't need to name any names, but some should come to mind pretty quickly. I told this to the central bankers, that this is monetary policy by the mob. They're trying to replace you with rabble-rousing charlatans, and they all, everyone agreed that this is far worse than the enlightened central bankers and so forth. Now, let's talk about the central bank going into the business. Yeah. It's a good question. Like, who are the voters on Bitcoin? You know, it's people who operate nodes, but anybody can hook up and become a node operator right now, right? So I have a whole nother lecture on, like, what's it mean to be democratic and what's governance mean? If you wanted to crash the Bitcoin network, you just need to double the network plus one machine. And then you have 51% by yourself, right? Now, what would this cost? $200 million of hardware? And this seems to be an arbitrage condition that is somehow violated in the market. Who would have a motivation to do this? It's not hard to think of people, you know, like Chairman Kim, Chairman Putin, ISIS, you know, whoever. I think that, you know, there's an inherent weakness in these open networks in that you can get yourself a majority if you're willing to pay enough. And if this thing becomes a serious currency used in the Western world, there are plenty of enemies who would take it down like that based on the current governance. And this is something that you might be concerned about. Yeah. Right, and that would be a different voting system, that you could vote by ownership of the Bitcoins. You could stipulate any voting rule you wanted, and I think this is one area where many of the digital currencies would benefit from some more thoughtful decision rules. But the way it is now, you can, through brute force attacks, just attach enough hardware and begin running nodes and so forth, and you could take over 51% of the network. So this is called a 51% attack. You know, it's widely recognized as a theoretical problem, and the cost of mounting a 51% is surprisingly low relative to the market value of the Bitcoins. So if there was a good way to short Bitcoins, I think, you know, this would happen almost immediately. Yeah. Yeah, no, not everyone has to go down the fork. And what happened with Ethereum is 15% refused, and they decided to keep mining the old blockchain. So there's a possibility of competing chains. In fact, this could happen every day. And the rule is basically that the longest chain wins. But this gets into some fairly arcane aspects about how to resolve conflicts. What if people turn off their nodes and turn them back on without knowing that there's a new block? You know, those kinds of problems come up all the time. And suffice it to say that whoever has the most computing power is going to win out in the long game. But in very short horizons, in 10 and 20 minutes, there's sometimes divergences and forks that then get brought back together. This gets into some aspects of coding that I don't fully understand, but there's a lot of good references about this on Reddit and so forth. Now, should the government make all the money electronic? I think the important first point is that this isn't such a radical idea because most of the money already is electronic. And, you know, through credit card companies and mobile payments and bank transfers and so forth, we're all pretty used to living this way. What would really change is the system of fractional reserve banking that we use to create most money would be gone. And the real thing that would change in your personal behavior day to day is that you wouldn't use cash for micropayments, you know, for Starbucks or whatever, that you'd really use electronic money for everything. So what would be the benefits to the central bank from making all the money electronic? Some of these are very simple to see. So number one is you wouldn't have to print the money and you wouldn't have to guard it with Brinks trucks and things like that. So simply the direct cost of printing, storing, safeguarding the money would go out. The much more interesting savings would be through the implicit insurance systems. The central bank worries a lot about things like bank runs and panics and failures of banks for not meeting their capital requirements. I'll talk more about this in a minute, but I think the number one savings is to get the government out of the deposit insurance business, which at times has been really, really expensive and creates moral hazard problems that I think you're all pretty familiar with. The government would also have a very precise lever over economic policy where it would have the bank account of every citizen and it could manipulate policy like giving tax cuts only to students. or only to people living in Idaho, or only to people who voted for their party, or whatever. Now, would we want the central bank to have this much power? It's an interesting question, but I think from the point of view of the central bank, it's a tool that is very attractive. And then things like tax evasion and money laundering would be completely gone. You know, if all the money's electronic, being tracked on one blockchain by the central bank, they would just take the taxes. And, you know, laundering money, the whole concept wouldn't exist, and so forth. So let's look at some of these things in a little more detail. What does it actually cost to run the system we have now? So the government spends $700 million a year actually buying paper and green ink and printing the money. This is not very much relative to the hundreds of billions that get issued every year. So I'm not sure that this is particularly compelling. And then there's private industry, the armored cars and so forth. The revenue of that industry, which you wouldn't need anymore, is $3 billion. The big cost, though, is really computer security. And this is very decentralized. Every commercial bank, you know, Chase, Bank of America, whomever, has an army of people defending against hackers. And this is a soft cost that you're all paying in the background, but it's a big one. It's hard to even put a number on this. I know that in risk management courses in business schools these days, what we call cyber risk is now a huge first-order topic, and that's really what the savings would be. It's a number that I really can't quantify myself, but I think it's probably pretty big. So this counts for something. But as I said before, the real issue is fractional reserve banking. And this is a quick slide that you might have seen in an intro econ course. This is a bank taking in a deposit where there's a 10% reserve requirement. So if someone puts in $1,000, you have to keep 100 in the bank, but you can lend out the other 900. And then you lend it out, and then it gets lent again with a 10% reserve. So the amount of money that's created is 1 over R, where R is, in this case, 10%, the reserve requirement, sometimes called the money multiplier. So we've had this system since the beginning of time, that banks have never had a 100% reserve requirement, and governments manipulate this, in fact, to stimulate or contract the economy as they think is necessary. But this is, of course, dangerous, because what if people actually show up and want their money? So this is what's called a bank run, and we used to have these in the old days, but in fact, I love this slide because nothing's really changed in the world, right? That's in the UK just a few years ago. It looked exactly like the panics that we had back in 1873 and so forth. So despite, you know, very sophisticated national schemes and so forth, this problem has never been terribly well solved. That if we have fractional reserve banking, ultimately the government has to backstop these banks and guarantee the deposits, which means that we all pay for it when somebody like Northern Rock doesn't have enough money because they made too many bad mortgage loans. So what's the cost of deposit insurance? We have a well-understood scheme in this country run through the FDIC, and I think you guys all know that your deposits are insured up to $100,000, blah, blah, blah. But everyone also believes that that's not a serious limit, that if any bank fails, the idea that a bank is too big to fail means that the government will come pay all the bills, not just the first 100,000 and so forth. And we now have the Dodd-Frank Act, where banks have to write living wills and promise not to get into too much trouble, you know, et cetera, et cetera. But the problems of moral hazard of banks have a free put option, meaning that if they can't meet their liabilities, they can put them on to the taxpayer. Every banker knows this, and as a result, bankers take too much risk, and from time to time, we have to pay the bill as a society. And so if you did away with the fractional reserve banking system and just let everybody open an account at the central bank and bank directly one-on-one with the government, you would save what is an enormously expensive and pretty ineffective system. I might not have made these remarks 10 years ago, but having lived through all the bailouts and the financial crisis, and looking even today at what's going on in Italy, there are banks all over the world in reputable countries that are teetering on the verge of collapse because basically this is an inadequate system that has not worked well for people. So, if you ask me, my personal opinion, should central banks get into the business of a national blockchain, I would say yes, and this would be my reason, because this system has shown itself to be so problematic and so expensive to the world. Now, you often hear the objection straight off, you mean you would take all the deposits out of the commercial banks? They would collapse. They would all be gone. What would this mean? And I say, this would be very good because we wouldn't have to bail them out anymore. Every month my paycheck goes into Bank of America, which is a bank that failed 3 times in the year 2008, right? And would I rather deposit it in the Federal Reserve? Sure. In fact, everybody would rather do this. And if Bank of America wasn't there anymore, would I care? And people say, well, there would be a lot of unemployed bankers. Say, well, okay. And then the real issue is that Bank of America takes my paycheck and lends it out. So they make car loans, mortgage loans, small business loans. They provide credit. So banks really take 2 things. They take deposits and process payments and so forth, but they also provide credit to the economy. Now, what people imagine, and the Bank of England Future of Money team has written a lot about this, is that you would still have companies in the lending business, but they would have to fund themselves very differently. So Bank of America funds itself today, and I'm not picking on them. It's also true of Chase and Wells Fargo. Pick your bank. All the banks fund themselves basically by getting demand deposits and then availing themselves of the free deposit insurance from the government. They would instead have to issue debt and equity. And they would issue securities, one presumes, with a much longer maturity. One of the big problems in banking is what we call maturity transformation, that banks fund themselves through demand deposits with their very short-term liabilities. They must be repaid on demand, but they lend long. They make a car loan with a 4-year or a mortgage with a 30-year horizon. And it's that mismatch of maturities which is at the foundation of the problem of bank runs and banks that sometimes overextend themselves and can't easily dig themselves out of positions. So this is really a ready-made solution for this, and it's sometimes called the narrowing of the banking system, where instead of branching out through fractional reserves and lending and relending the money, you would go directly against the government as a depositor, and the whole system would be narrowed to just depositors and the government. The narrowing of the banking system was an idea that was proposed back in the 1930s under something called the Chicago Plan. And it came right out of the faculty of this university and was really largely forgotten for about 80 years until it's enjoyed a real renaissance and revival in the context of this discussion. So, when I taught my course for the first time, I had actually never heard of the Chicago Plan, and I had these libertarian students say, yes, we're going back to the Chicago Plan. That's finally, after 80 years, people see the wisdom of this and so forth. But the narrowing of the banking system is now something being openly discussed in a lot of academic papers, and the whole benefit to it is really taking all this risk and moral hazard out of the system. Now, in terms of fine-tuning monetary policy, the real thing that people focus on is the ability to pay negative interest rates. So this is a time series of the U.S. interest rates going back to 1990, and they go up and down and so forth. But as of 2008, you see that there's been a barrier at 0, that the government would have wished to pay lower interest rates, but the public can defeat a negative interest rate by just holding cash and putting it under the mattress, right? Cash yields 0. And if you're going to pay negative interest rates, everyone's just going to hold cash. Not electronic money. With electronic money, they can just erase 1% of your balance every week, or whatever they feel they need to do. So there's a very provocative speech given by a man named Andy Haldane, the chief economist of the Bank of England, where he hones in on this issue. And the speech is titled, "How Low Can You Go?" And he says, central banks not only want to pay negative interest rates, but for demographic reasons, this is going to become more and more necessary because of changes in population growth and so forth. And he says the only way to really do this is with electronic currency, because otherwise people are going to hoard cash. So Haldane's argument is that if you want to pay negative interest rates, and you may even need to do this, this is the way to go about it, to make the money electronic. And this is really the thing above all else that got people in Parliament up in arms. Like, you're going to erase 1% of my money every month, and I don't get to vote on this and so forth. So we'll see, but I think as a matter of economic logic, this is a pretty compelling case, that in a world where negative interest rates are popping up more and more, the only way to administer this monetary policy is to take the physical cash out of circulation and make it electronic. So stay tuned, but I think you're going to see more negative interest rates and more pressure for central banks to make the money electronic for exactly this reason. Now, the other aspect of this, and I suggested this a few moments ago, is that in addition to low interest rates, you can have finely targeted monetary policy. Today, when the Fed does things like quantitative easing, it's benefiting very broadly the whole economy, but you can't really target it even at any region, or certainly not at any group. But if people have electronic accounts at the bank, you can have regionally targeted, demographic targeted. You could give tax cuts to women, or to different ethnic groups, or to people over a certain age, or whatever. And it would give an awful lot of power to the central bank. You may or may not want them to have this power, but it would certainly permit much more finely tuned, targeted monetary and fiscal policy. So this is a really big issue, but it's one that the technology is now forcing us to think about as a possibility. Now, I'm running out of time, and let me just tick off a few objections. I think many of these will have occurred to you guys already. Privacy, again, becomes a big issue. If the government has everybody's bank account right in front of them, it's impossible to hide. And not only that, if it's a blockchain, maybe we can all see each other's purposes. I would say that the IRS has actually been pretty successful at keeping tax returns private. You almost never hear about people's tax returns, not even the president's. And for that reason, I think that the government probably could design safeguards to keep accounts private in a way that you wouldn't worry about this maybe so much. But the political power, the central bank in a system like this, central banks are already very powerful, but they'd be much, much more powerful. In fact, probably much more important than Congress and the president. And this is something that's going to give people a lot of hesitation. Do you really want to give them levers that are this strong to do that much good or harm in the economy? And I think this is a discussion well worth having. What about people who can't use computers? There's a lot of older people, and by older I mean like over 35, who can't do email. And I don't really want to pick on my parents, but they went to Harvard and MIT, and if you ask them to attach a file and send it to you, it's just not going to happen, at least not so easily. And so rich people tend to be older, and they tend to be less comfortable with computers. So if we threw a switch and said, tomorrow, all of the money's electronic, Mom, and you have to do it on your cell phone, this would cause many problems. So how to transition the people who are less comfortable with digital stuff into using this system, I think, is maybe a 20-year project. And you're probably going to have to run these things in parallel and keep the old system going until, it's like you couldn't just get rid of all the electric typewriters the day the word processor was invented, right? There's a transition period. Finally, this is the big problem for the U.S. Where is most of the U.S. cash? It's offshore. This is our greatest export. We print these green pieces of paper. We export them, we trade them for goods and services, and they never come back. Instead, they're held in suitcases by criminals and rogue governments and so forth. And if the U.S. were serious about defeating money laundering and so forth, you would just get rid of the $100 bill, the way the Europeans are getting rid of the 500 euro note next year. But we would lose an incredibly valuable export industry. No other country really has this problem, but you would have like $1 trillion of dirty money held by El Chapo and people like that who would want to bring it back on shore and put it on the Federal Reserve's blockchain. Now, would we accept this money, from terrorists and Putin's oligarch friends? Maybe we would, but I think we would lose something that is uniquely valuable to the U.S. And for this reason, I don't expect the United States to be the first adopter. I think we may get dragged into the parade, but it's going to be some of these smaller, more tech-savvy countries. Singapore looks like a really good candidate for this, but some of the Nordic and the smaller European countries are probably going to do it. The U.S. eventually will have to do it, but probably not until Canada, England, Australia, and so forth have already implemented it. I think this is going to be a very, very interesting thing to watch. It's going to revolutionize central banking and monetary policy, probably over the horizon of 10 to 20 years. And as I said before, it's hugely ironic that the innovation of Nakamoto in the end is going to be co-opted by exactly the same central bankers he was trying to do away with. So stay tuned. I'll stop now and take questions. And do we have the mics to pass around like yesterday?
Well, this has really been
Yeah, it's on.
This has really been a very compelling conversation here. And I raised two questions. Number one, if you go to negative interest rates, which obviously there's a lot of incentives to do that, how is that any different than the Bitcoin system? Because when you go to negative interest rates, you're actually implying inflation, no growth in the economy. And how do you adjust to all the other things that need to be adjusted with negative interest rates?
Yeah, you think about cutting the interest rate to stimulate economic activity, to make it cheaper to borrow for businesses. And if lower is better, 0 is just a number. So -1 is cheaper than 0, -2 is better than -1. But you begin to run into problems that fall under the heading of behavioral economics, that people have reference points in their mind, and once you cross those reference points, they begin to behave differently. So we see this all the time in investing, that people don't like to sell investments that have dropped in value, just because they don't want to recognize loss. There's all kinds of crazy things people do. So I think there are many answers to this. One is in the long run, people will learn to be rational and will accommodate to this. And the other is that you need teams of psychologists to advise the government about reference points. I mean, go upstairs, talk to Thaler and Fama about this for these 2 points of view. I don't have a great answer to this, and I do agree with the nature of your question that negative interest rates bring a lot of behavioral reference framing questions onto the field.
And the only other question is, what happens to capitalism? What happens to markets? What happens to price discovery? I mean, all these things go out of the window if we got a bunch of people sitting in a closed room deciding that what the price of money is and the supply of money, like they did in the Soviet Union when they were determining the price of wheat and tractors. I mean, there's no capitalism under this.
We could have a long discussion, because I think there's a counter argument that you have more price discovery and freer markets once you make everything electronic on a transparent blockchain. But I do see your argument that if they manipulate the levers that they have too much, and I think you're going to hear this argument umpteen times for the next 10 or 20 years as people figure out how to accommodate this technology and build it into central banking. But you're asking exactly the questions that trouble many people. Who has the mic? Yeah.
You mentioned the cost of securing money from crime earlier, but I'm sort of wondering how you might protect electronic money from crime. Like under the current paper money system, if someone mugs me, they can force me to give them all the cash in my wallet. And if they're getting really ambitious, they can force me to go to an ATM and withdraw as much as I can, which is typically about $300, and also hand it over. If someone came up to me and I had my electronic card in my wallet, which accessed my entire bank account or whatnot, and they said, all right, transfer the whole contents of your bank account to me, would it I'm concerned this could make it pretty easy for muggers to
Yeah.
steal pretty large amounts of money.
No, these were the slides I never got to at the end. And, the security, my very short answer to what I think is an interesting question is that this would be better. You wouldn't have as much. Because the system we have now has so much crime and hacking. This is an event that you may be familiar with. Last summer, the Central Bank of Bangladesh had its money on deposit at the New York Fed, and it was stolen by hackers using a Philippine casino as the front. With just a comically bizarre operation that got hundreds of millions of dollars out the door. There's got to be a better way than the SWIFT codes in the system we have now. I agree that crime is always going to exist and there will be cyber crime and so forth. But looking at what we have now, it just can't possibly be as bad as what we're already living with.
So would the police sort of have a system where I go to the police, I report the theft, and the government reverses the transaction or something?
I hope so.
Or
Yeah.
it would be sort of complicated because, like, he could take my money and start spreading it all over the place. And...
Yeah, I don't know the answer to your question, but I do know that the system we have now has major, major problems in this direction, and that there's the promise of making it not as bad as it already is. Where's the mic? Yes.
Here. Yeah, a question about the central bank and blockchain. So under this scheme, who will create the blocks, the new blocks? On the blockchain?
Janet Yellen would.
And who will be, who can view them? Everyone can view
no,
the
this
entire...
would be a private blockchain, a permissioned one where the central bank would ration access. And who would get to see it is whoever the central bank thought should see it. So this might be nobody but them, for instance. Or for very limited purposes, the tax collector or whomever. But these would really be political decisions that would have to be worked out. But the Board of Governors is exactly who would have the authority.
So what's the advantage of using a blockchain as opposed to any other secure database? I mean, don't you lose the entire premise?
Security is exactly the advantage, that blockchains can't be rewritten and so forth.
They can be rewritten by the people who created them, right? You can. It's very difficult to go back maybe 10 blocks, but you can change the current block very easily.
The Bitcoin blockchain, 8 years of of resilience has not been hacked and so forth. That's the promise, is that really this is a more secure system than any database that's been developed before.
But part of the security is because it's visible to everyone and everyone
Right.
can, and not one organization creates the blocks. If one organization has a monopoly of creating the blocks and viewing them, then don't you lose the entire...
Yeah, no, I think you either have to completely trust your central banker or open it up, as you're suggesting. It would be kind of fun to open it up. But this would, have many interesting problems about assuring there's enough mining and so forth, and worrying about hacking attacks and, 51% attacks and so forth. Yes?
Thank you for the lecture. A follow-up question to the point you made earlier about offshore dollars and the role it was playing. I mean, it happened in India already because of the central bank basically suspended big bill usage.
This has been a wonderful event to watch.
Yeah, I mean, so because of the transparency that's embodied in the blockchain, so essentially we need a cleaner economy somehow, where cash economy is not an essential part of the entire society, to be able to transfer a current system to the blockchain. But cash economy is the central part to many economies, and even for not only developing countries like China and India, where it's a way of paying corruption, but also in the advanced economies, there is no way we're just going to abandon that part at all.
The India event is very interesting. And for those of you who haven't been following this, the Prime Minister announced with 4 hours' notice to the whole country that the two most widely used banknotes were going to be canceled at midnight. So this would be like saying all the 20s and $10 bills are no longer good money. Now, what they allowed people to do was deposit them in their local banks, So long as they filed the tax declaration. Like in this country, you have to, every time you deposit $10,000, you have to declare it. It's a very similar system. And it was an attempt to bring what they called black money back into the banking system. 86% of the currency was canceled. Now, if you canceled 86% of the cash in the U.S., what would happen the next day? You might think in terms of economic collapse and pitchforks and Armageddon. This didn't happen in India. There was really a very orderly process. It surprised people how easily it was taken. And part of the government's agenda is to force people onto electronic payment platforms and have much less of a cash economy where nobody pays taxes. Now, this is a work in progress, and I've never seen a government experiment with such a radical basis, which actually seems to be succeeding after the first 2 months. So we will be talking about this in my course maybe by April. One of my colleagues, Professor Acharya, was just named the Deputy Governor of the Bank of India. He starts January 20th, and now he's in charge of this. And I told him he's going to be guest speaker in April. I want to hear, how is this going and what's the central bank worried about? But this is definitely aimed at tax evasion in the underground economy that flourishes, as you said, in many countries. And you now have a technology that may cut the legs out from under this. Huge political problems, for sure, but very, very interesting to see it attempted and maybe even succeed. Yes.
Do we have any clues on what a Trump administration might feel about blockchains and the levers of monetary policy that they might entail?
I don't think he even knows what it is, but it's actually been a little bit surprising that often in presidential campaigns, the term of the current Fed governor is an issue that is debated. I haven't heard one word, one way or the other, what Trump thinks of Janet Yellen and what he might do with the Federal Reserve. He's talked about the Supreme Court and different cabinet agencies. The Fed just hasn't come up. I think the answer to your question is no, we don't have any indication. And if I had to guess, I don't think he's actually thought about it. But clearly an important decision. I think her term comes up in the first year of a new, this is the cycle of Fed appointments, is that after about a year, the president has to decide whether to reappoint. My expectation is that he will reappoint her, that she's really done an outstanding job. She's very, very good at what she's doing. Yes, I'm sorry, where's the mic? Yeah.
Approximately every third or fourth slide, you show either an actual problem or potential problem of bad behavior by one group of parties or another, usually government or non-government, central bank, not.
Yeah.
And I'm wondering if underlying all of this, aside from fascinating technology, is essentially ethics or morality, ethical behavior, moral behavior. If that's something that we don't, in a sense, take for granted or assume or presume, or, I'm wondering if we can mine ethical behavior maybe. But anything you could say would be useful.
We all have somewhat different ideas about what is ethical. And especially at this university, one vision of morality is an economy based on free consensual exchange. And the government is often thought to interfere in people's freedom, and what would be most ethical is to allow people to do whatever they want. Other people talk about impact on the environment and externalities. I think you may have asked me about the consumption of energy on the Bitcoin network, and could this be viewed as ethical to burn so much oil to mine Bitcoins out of thin air? We would get many different points of view about this, and how we make decisions about this in society ultimately is at the ballot box. But yeah, as a philosopher or as an ethicist, you have a field day with this material. I mean, that's one of the reasons I like it so much, is that it forces you to examine some of the normative beliefs underlying the structure of markets, the role of the government, and so forth. And it's very easy to find people who think lots of aspects of this have ethical problems. And this one about the power of central bankers is, one of the big ones, I think. Yeah.
I wonder what the effect of this would be on what people talk about of contention or competition over world reserve currencies, that
Yeah.
China has thought of making the renminbi replace the dollar and so on. But my speculation is that it actually won't make much difference in the sense that the discretion exercised by the Fed has overall been moderate, and the power, that plus the power of the United States, made the dollar currency or a money that people want to hold and transact in. And so discretion, well exercised, establishes a brand name reputation, and that would be true with the electronic currency as well.
That was really my point about this suitcase of $100 bills, that people hold these precisely for the reasons that you said, that they believe that the Fed won't get out of control. It's least likely to print more dollars than any other central bank. Now, if the Fed went onto a blockchain, it would be sort of writing off the benefits to date of all the cash held offshore, which is basically a bearer asset. But that's not to say that they wouldn't reclaim that position very quickly. I think one question you have to make is if you had a national blockchain, who can open an account? And I've read very carefully what the people at the Bank of England said. And at one point they wrote every citizen. And I was over there meeting with them. I said, what about all these Polish plumbers that you guys are, can they open an account? They're not citizens. They're citizens of Europe, but not, and they said, well, we haven't thought about this. And so what about tourists? What about people in hostel? Who's allowed on? And I think if you're going to be the world's reserve currency, you have to open it to foreigners. In fact, to many undesirable foreigners. And it's an interesting problem. Yeah. And, we'll see. I think this is a question they'll have to think about very, very carefully. It's occurred to me on much the same terms as you asked it, and I think it's an interesting problem. Yes?
This may get into some of the behavioral factors.
Mike?
So along the lines of some of the behavioral factors you're talking about, wouldn't you expect to see people taking value out of currency and moving more into hard, real assets? So thinking about people who bought gold bars during the financial crisis or real estate. So if currency is completely digital and transparent, wouldn't you expect to see people less willing to participate in the system?
You might. If people really didn't trust computers, they might withdraw from the grid and put everything into gold. I had to have dinner with a guy like this about a month ago. I got seated with him at a conference, and he thinks that gold is the only thing that endures. And I told him that gold is valuable only because we agree it's valuable. It has no real use. And it wasn't a very interesting dinner, but these people are out there, and they may become more numerous, sure. And maybe they get what they deserve. I don't know. But yeah, and whether we should even worry about that, I'm not so sure. Computers are here to stay. And, if you don't know how to use one, you should, really. Yeah. Yes.
So I was wondering, say there is a transaction happening between two parties where something is promised to be paid, but the party does not follow that promise. Is there a way that, other than smart contracts, that Bitcoin also solves that part of not doing your part of the contract? And if not, what kind of mechanisms would be involved in the future, or is it just that in the end people will be working towards?
Yeah. I mean, what you're talking about is simply giving credit to somebody, letting someone buy on a promise. And typically, there's no way to compel them to pay, and what you would want is a third party to agree to stand in their shoes. So this may be the future of MasterCard and Visa, that they would lend you digital currency and ultimately stand behind your promise to pay. I think there's definitely going to be evolution in the markets for credit along these lines, and ultimately smart contracts, maybe not against the debtor, but against the guarantor, would play the role that you suggest. I think it would be It would be better in the sense that all these people today have capital requirements and all kinds of regulatory oversight, which you could just replace with some very simple code and greatly reduce the cost of the whole system. So a lot of this is really about cost reduction. Okay, I think maybe one more question, and then we need to draw a line under this. So.
Bitcoin mining, other than an intentional sabotage for 51% attack,
Yeah.
what incentive would miners have to undermine their own value? Isn't there the economic incentive to keep the value? So can you think of a scenario or scenarios where 51% of the mining community would raise the value to 30 million Bitcoins and undermine their own economic prosperity?
Yeah, no, I think that a lot of what keeps the system running is because the way the mining is designed co-ops people into good behavior, for sure. And a lot is written about this in other places. I think the other issue for the miner comes on the other side of the equation, which is cost. What they really want to do is avoid having to make investments in more hardware to maintain their positions. And things like increasing the capacity of the network would open it up to the need for more miners and undercut the value of their positions and so forth. So I think part of their motivation is not just maximizing the value of their revenue, but minimizing the value of future investments. And you need to look at some of these problems through that kind of a lens. Okay, so thank you guys all for coming out. I realize most people have left, but I appreciate the attention. I think most of you have been here all 3 days, and many good questions. I've met a lot of very bright people, so thank you for the invitation to be here and for being so attentive and such a good audience. Thanks a lot. Thank you.